All right, thanks for joining us, and sorry about that. I was really enjoying that music that was playing there. So thank you again for taking time out of your day to be here with us today. I just want to make sure that everybody understands. First of all, we are going to leave time for Q&A at the end of today, but also most importantly, I want you to understand that anything I say today is not meant to offend you. I understand we all have our own political opinions, and everybody's entitled to those political opinions. And so I want to respect that. That's part of the beauty of America is we are entitled to those. We can voice our opinions freely. We can go to the polls, and if we don't like the results, we can get active immediately and try to change them 2 years from now. So with that said, let's talk specifically about what we've learned so far since the election. First off, I use this in our pre-election webinars, and I said, hey, this is the most important election of our lifetimes. Well, the final numbers are not official yet. It seems like we've had the biggest turnout going back to the 19th century, and which is something to think about. And, you know, I think this should have been expected. If you look at what's happened over the last 4 to 5 years, we've seen a lot more political activism. We've seen protests and riots and, you know, social media blowing up with all these different things. And people have, you know, suddenly awoken up, and they're taking an interest in there after a very low turnout the last several elections. To me, this was encouraging that this many people voted. A little bit humbling as we left after voting on election day. One of our 14-year-old twins said, Toby and I get a vote for the next president. And we thought, wow, that's coming up quick. And I've done a lot of demographic research on the different generations. I have not done it yet on the Zoomers, which, by the way, that's the nickname I'm giving them. Get it, Gen Z, Zoomers. That's how they do school now. But I don't know what they're going to be called. So I don't know what that's going to do, but that is another wrench in the demographics that our country is, because the Gen Z, along with the millennials, are a very large generation, and they will be a voting age. Some of them will, at least next time around. So let's take a look, though, at something that I have been saying over and over and over again for the last 10 years, really, which is that the independents truly call the shots in our country. We have a very divided country. Very far right, very far left people tend to control the parties, but we have a lot of people who don't identify with either of the parties. By the way, I am one of those independents. I won't get into the reasons why. Again, we're all entitled to our political opinions. I just felt like neither party represented my overall beliefs, and I want to just be able to pick which side I think works best for the current situation. But one thing that's interesting, the very final numbers just before the election was we actually saw Republicans pick up a couple percent off of the independent category. So going into the election, at least according to Gallup, we saw a split, even 31 to 31 as far as people who identified as Republican or Democrat, and then 36% said they were independent in the polls. So we can see the results of that as we dig into it. We're going to look at what that means. But I think clearly we need to understand that both parties really need to get this through their heads. Is if you look at the generational identification to parties, the millennials, almost half of them do not believe either party represents them. And then you look at Gen X, almost 40% of them. These generations are going to get bigger and bigger as far as voting numbers go. Again, I don't know where Gen Z falls. Probably, similar, because they've been turned off by the two-party system. And we saw this really come out during the election. Let's look at a couple of those things that we've learned so far, based on the data points that I've looked at. First of all, when we look at this, we need to understand about 6% of the vote in 2016 went to, went to a third party. Half of those went to Gary Johnson, the Libertarian, and then the rest were kind of split out amongst others. So that's why we see some big swings, and sometimes both candidates picking up votes. But what I think is interesting here is if you look at the age groups, pretty much, from the 18 to 44-year-old vote, we saw Joe Biden pick up a lot of people. We saw him pick up again, kind of split, picked up across the board from the independent or the third party votes, with Donald Trump only, really having an advantage for people who were 45 and older. And when we talk about advantage, it was almost 50-50 still. So the people who elected Joe Biden, if you look at that, were really the 18 to 44-year-olds. And that's half of Gen X, and that's half, all of the millennials were the ones who elected Joe Biden. So remember, most of them do not identify with either party. So this is where this gets really interesting. Obviously, the top liberal votes, Joe Biden and picked up some of the conservative or moderate votes. Donald Trump kind of stayed the same with liberals. I was really surprised, that he got any, but he did. But look there in the middle, Joe Biden picked up 12% off of what Hillary Clinton did from those who identified as moderate, with Donald Trump losing 6%. So literally, if you look at the total third-party vote of 6% from 2016, and what Donald Trump lost is literally all the third-party people plus a little bit more moderates ended up going with Joe Biden. So there's some things we can learn about this, and I think it's important as we set the groundwork for what the next 4 years, or at least the next 2 years, are going to look like. Is this was not the big change election that a lot of the Democrats really expected. They expected this big blue wave. Almost every Democratic president in their first term had full control of Congress as well. That may not happen this time. And we actually saw 10 seats at least lost in the House from the Democrats. So what it was, and this is not a slam on Donald Trump, because he was elected for a reason. He was elected because so many Republicans and obviously the moderates were upset with the way things were going, and they thought, well, here's somebody that could really shake things up, and obviously he accomplished that. But most surveys showed they just want a more moderate government. They don't want something that they're not quite sure what they're getting. And if you look at the Democratic primary, there was all these really far left candidates that Joe Biden beat in the primary. So the Democrats said, we don't really want these far left policies. We want something down the middle. So we'll see what happens with policies, and we're going to talk about those in a minute. But I think that's the big takeaway here is this is important going forward as we look at the future of our government. Is the younger crowd, under 44-year-olds, controlled the vote. They swung things. And the independents are the ones who really went from Donald Trump over to Joe Biden during this election that gave him that. So that's who elected Joe Biden, was younger Americans, younger being 44 and younger, as well as independents are the ones who selected him. And so whether or not he and his party embrace that will be, I guess, topics for other webinars that we run. But more importantly, let's look at some of the outcomes. We've talked about some of these in my pre-election webinars. I think first off, we can look at developments since I had this presentation approved. We could pretty much, assume I don't see any chance that Donald Trump will be president. Just legally, mathematically, I don't see that. So we X those out. There's no chance for Republican full control. There's also no chance for a Republican Congress. So we'll ignore these. These are the average returns for the stock market during different scenarios. So really all we're down to is Democratic president and a split Congress, which I think is most likely. Second most likely is a Democratic full control of Congress. So I think it's interesting, but I did say be careful with statistics because we don't have a lot of situations where all these numbers were. If you look at the Democratic president with the split Congress, those only two occurrences were under Bill Clinton and Barack Obama. And it wasn't at the beginning, it was near the end of their term. And they already had the wind at their backs. The economy was doing great. And basically the split Congress gave the stock market confidence that nothing was going to shake up the train that was already heading in a really good direction for stocks. But what I think is interesting is that second data point of Democratic full control. Economists would say, well, that's that's not going to happen. Democrats are bad for the economy. Democrats are bad for stocks. Maybe they are, maybe they aren't. Because this data, as I dug into it deeper, what we found was it's heavily skewed from both of FDR's first terms. Remember, he had two different terms. They had Democratic full control. Well, the first one, 1932, we saw the stock market go up 90% just in 1 year. And so over his period, even though we had a little bit of hiccup in 1936, he had this huge gain, as well as Barack Obama in his first term. Remember, he stepped in at the really the bottom of the stock market. And so both of them came in and had really a market that could only do anything but go higher. So it's heavily skewed. If you back those out, it's slightly below average as far as what the returns are. And we have that, around 6% as the average, going back to the beginning of the 20th century. So keep that in mind. This is interesting data. You'll see it show up in different financial publications, but be very, very careful with these statistics. Now, let's focus on a few things, though, of what we know. And I showed this table during my pre-election things. Again, it wasn't saying that one is better or worse for the economy. It's just this is what Wall Street is saying about their different policies. And I think we need to focus now on, the real question of the day is, what's going to happen with taxes, and will this stimulus that everybody has been hoping for on Wall Street be enough to help the economy? And we'll talk about the economy here in just a minute, but that's really the big question, along with what's the regulatory environment going to look like? Because regardless of Congress, as we've learned with Donald Trump and Barack Obama before him, those executive orders, those directions to the different departments are very important. And we don't know that. One thing that I think is interesting is the Senate. As I'm looking at it more and more, we have some what you would call moderate Democrats, and you definitely have some more moderate Republicans. They're saying, and they being the political experts, is if the Senate is split, or especially the Senate is Republican controlled, that's going to make the regulatory agencies much more moderate. It may even keep some of Donald Trump's appointees on board going forward, just because Joe Biden will know he can't get a very liberal person through the Senate as far as confirmations go. So we may have a very stable government for at least the first 2 years, which is something we haven't had for a while. So that's something that is an unknown. And then, of course, we don't know the cost or the benefits of the stimulus. I talked about that before. There's a huge math problem with Joe Biden's economic plans, and I have the chart on there. But let's be clear, Donald Trump had a huge math problem as well, because you can see if you zoom in there, even before the pandemic, the tax cuts were not paying for themselves. We were seeing the deficit continue to grow at the same, because not only was economic growth not that great, but the tax revenue was coming in lower and lower. Remember, the assumption was if we cut taxes, we're going to boost growth, and gross tax revenue wise, we're going to actually receive more with lower tax rates. And that simply didn't happen even before the pandemic. What you see, though, is we've all heard about Joe Biden's tax plan. Very expensive, $3.4 trillion in revenue. The problem is he's proposed $5.4 trillion of spending. So the question is, where does the other $2 trillion come from? On the chart, it looks like this. And you could see, even with Donald Trump's budget, we were going to be running a very big deficit. Biden's only expands that. That's going to be a really hard pill to swallow for a lot of the moderates on both sides of the aisle, frankly, as we go forward. Because I think the one thing, if we remember, younger people elected Joe Biden. Those, again, 44 and younger moderates elected Joe Biden. And they already know midterms are coming up. And in a lot of times we see the midterm elections go against the president, especially over the last 20 or 30 years. So they're not going to be able to do runaway spending. They're not going to be able to do massive tax increases. So the policies are going to be very interesting, because if you look at surveys, whether they identify to the left or to the right, most younger people, 44 and younger, are fiscally conservative. They're very concerned about the deficit. That keeps showing up in the surveys over and over again. So that'll be something to watch. And especially, this is a chart I've shown several times over the last 20 years, and it continues to get worse and worse, of you can't tax the rich and get out of our deficit, and you can't just cut wasteful spending, because if we got rid of every single government department out there, we still would be running a deficit. And that's because Social Security, Medicare, defense, and now interest payments literally are eating up all of the tax revenue that we're getting right now. So even if we did Joe Biden's policies and it didn't hurt the economy on tax-wise, we would still have a deficit. And we saw that because he wants to raise taxes, but also increase spending. Just doesn't work out mathematically. And again, the younger, more moderate generations, those who elected Joe Biden, those who took seats away from the Democrats in the House, those who are giving us mostly a Republican Senate, they are very concerned about the deficit. They're very concerned that not only are they not going to get Social Security, but it may not be sustainable for people already receiving Social Security. They've heard about it for 20 years and seen politicians do nothing about it. So that's going to be really the thing to watch here after we get through the pandemic. We also have to understand is we've seen two different economies. The stock market is in at or near an all-time high, depending on the ticks in the market. I think right now it's almost back to an all-time high, and people look at that and say, well, see, the economy must do fine. But what we're looking at is the K-shaped economy. Is there's people, myself included, and many of you out there listening to this are in that upper part of the K. You either weren't impacted by the shutdowns, you work in an industry that wasn't impacted, or you have a job like ours that actually has thrived because people need more help. And I can work from a laptop, I can work from wherever I want. And I'm better off, and many of you on this call are better off than you were when COVID started economically. But we have a whole other portion of the economy that is struggling, and that's the trouble. Because if we lose that, if you think of just the physics of that, if you lose that part of the K, it topples over. So we need to figure out some way, and I don't have all of the answers to do that, but our country has to come together again. This is where I think a more moderate government helps, because they can try to find ways, well, how do we help the K without just completely alienating one group of the population? And I think that's positive. From a many of you out there on the call, this personal to me. 3 weeks ago today, we unfortunately our son Tyler died. He was 22 years old, and I appreciate everybody who's reached out to me. It's been so heartwarming, and Brandy and I appreciate everything of that. And I don't want to get into that, and I thought I could get through this as well, but I posted a blog. It's just called Perspective, and I put the link there. But he was fighting. He was in the lower part of the K. Where as parents, we didn't believe in handouts. We gave our kids everything they needed as far as education goes, morals, everything you need. He was fighting it. He was working 3 jobs. He was struggling just to piece things together, and COVID just made it so hard on him. And I know there's millions of people out there in Tyler's situation. So we have to be careful from our seats to not just believe that because we're fine, the whole economy is fine, because the stock market's at an all-time high, everything's great, because it's not. And I think it's important to look at the thing called the Consumer Comfort Index. And I got this data yesterday from Ned Davis, and so I didn't have time to make it really nice. I love their research, but sometimes their charts are a little hard to read. But notice the scale is a little bit different here. Republicans, if you ask them 3 things, what do you think the state of the economy is? What's the state of your personal finances? And do you feel it's a good time to buy the necessary goods and services? Are you willing to spend more money right now? And you could see Republicans took a little bit of a hit. The gray bars are the recession, so basically all of COVID. And you could see, though, they're somewhere between around 65% confident or comfortable in the economy. If you go down there to the Democrats, they're all the way down at 40%, and you can see it's been pretty flat really going back into the fall. And then finally, independents, who are again the ones who elected Joe Biden, they've improved a little bit, but they're at 45% comfortable. So Republicans 65, Democrats 40, independents 45. So you could see a large amount of people, for whatever reason, they don't feel comfortable with the economy. And you could look at some things why. You look at overall GDP, and this is something that ignores all the different annualized numbers that we're seeing as far as GDP releases go, and it just boils it down to where's the economy at? Well, we're 4% down below where we were at when we started the year, but we're all the way back to 2017 levels as far as economic output goes. But again, certain groups of people are better off than they were, which means there's certain people who are down way more than 4%. And it's borderline a Great Depression for some of those people, depending on what industry they work in, what jobs they have, that, or lack of jobs. That's something that we have to address. It shows up in employment. We're at 93% of the February levels, but as far as number of jobs go, we're all the way back to 2015 levels. But keep in mind the way they count these statistics. Tyler's 3 jobs where he worked anywhere from 8 to 20 hours a week, making anywhere from 10 to, I think his best was $12.50 an hour. I think maybe one of them he had $15 an hour, but unfortunately only 8 hours a week. That's 3 jobs in this chart. The government doesn't count people working, it's the number of jobs. Whether you're working 8 hours or 40 or 60, it's one job. So it's an economy struggling. We know it's because of COVID. We know it's because of decisions that were made early on. And I said from the beginning, in February, I even said, we can't let hindsight bias influence our what's happened. And so I think there's been some bad decisions and there's been some good decisions from both political parties across the country. But right now we're seeing a spike in cases. And I know a lot of people, including myself, thought, well, hey, we're treating people better. This is younger people. We're testing more people. A 10% positivity rate is okay. However, unfortunately, what we're seeing is even with all those developments, the number of deaths from COVID is spiking. And it's something that is in some cases leading to a sharp shutdown. And I hope and pray that that's not the solution across the country. And I don't think it is. Joe Biden has a lot of moderate Republicans and Democrats on his COVID and economic task force. And he knows better. He knows you can't just shut down the entire economy again, but we got to figure out a way to stop people from dying till we can get to the vaccines. And we're probably looking at anywhere from February to June before we have enough people vaccinated, enough of herd immunity, we have warmer weather. So we have this gap. And yet the stock market is just running away saying, woohoo, we got a vaccine, it's off to the races. But we don't know what happens in this gap. It's this huge air pocket. We don't know what businesses will fail, how many more jobs are going to be lost, et cetera, et cetera, et cetera. Yet the market is celebrating. Unfortunately, though, again, another busy chart from Ned Davis, but I think it's important. The concept here is when you buy at very, very high valuations, and that's where we're at now. Even if I take out the current earnings and we go back to 2019 earnings, stocks are in the extremely high valuation category. They're the most expensive. What that means is you need to lower your expectations if you're in a buy and hold strategy. Because if you bought today and sold 10 years from now, the chances of you having even average returns are very, very low because you're buying at high levels. Also, the chances of you having negative returns from today till 10 years from now are extremely high. The only time we've had negative returns have been when we're in this high evaluations. Now, I'm not saying that's going to happen, but I continue to see people explaining away why it's okay that you're paying very high rates for stocks right now. And just trust me, I've done this for 25 years. I've studied history. It's never different this time. The reason the stock market has averaged 8 to 10% per year, regardless of the 20-year look back periods, including the Great Depression and all that, it's never been much higher. It's never been much lower over those periods. It's because when stocks get really, really highly valuated, they go through a very large correction and then they're in trouble. And so if you're retired or retiring in the next 10 years, this is the concern. You are the ones in danger. And so please, please, please talk to your financial advisor. If you don't have one, talk to us directly. You can find our contact information at scmwealth.com. We'll help you find an advisor who can help you with your situation, just to give you a second set of eyes on that. Now, what's our game plan? Because I don't think it's going to be as terrible or as great. I think it's going to be somewhere in the middle, and we might have some great and some terrible, and it might go back and forth. Number one, though, our behavioral approach is you got to have a financial plan. It doesn't have to be simple. I've written out plans on a piece of paper for people that just said, you need to save this, you need to pay off this debt. That can be your plan, but everything has to go in the framework of a plan. What's your cash flow coming into your investments? And then when you're retired, what's it going out? And then blend that with your investments. And the nice part of working with SCM is this chart highlights all of our available options, and we can customize. We can take these as building blocks to build portfolios for our clients. And if you're a current SCM client, we've already done that. We've also sent out surveys to have you retake your risk assessment, so we can look at where you're invested and say, based on all of this information from you, based on the current market environment, are we in the right portfolio for you individually? There is no one size fits all approach to investing. It's not easy. It has to be customized, again, with the framework of that financial plan, cash flow, and your personality, all sorts of different things. The lowest risk stuff, the bonds. Obviously, everybody knows interest rates are atrocious right now. We know that. And we have ways to try to navigate that. There's opportunities in fixed income, and there's going to be dangers in fixed income. We are designed to do that. And again, within the framework of your plan, we have ideas. So the point of this chart is we have lots of options. All of it, though, will not be based on my political opinion. And also, it will not be based on your political opinion. Because the one thing that is important is we know things are not going to work out the way we think they will, good or bad. We also know we as humans are very bad at making decisions, which is why we follow a quantitative approach to investing, which goes back to that. My number one rule of election year investing, and whether it's in 2020 or 2022 or 24 or beyond, is don't let your political opinions influence your investment decisions. I've been saying it since 2000. It's super important for you to understand. We don't know. I don't even know. We may have to do another webinar before the end of the year. I hope things settle down. Honestly, I think we could all use that. We don't know what the Senate's going to look like until early January. I think January 5th is the Georgia primaries, or the runoff elections for Senate. That's literally going to shape what happens over the next 2 years of the results of that. So stay tuned to the blog, scmwealth.com. You can see there under blogs. There's the link to the risk questionnaire if you need to see that. So I understand it's trying times. We're here to help. I hope that everybody out there does have that same sense of calm that I have, that we are prepared no matter what happens. I know we wanted to keep this at 30 minutes. So this was my full formal presentation. If you have to go back to work or back to the kids or whatever it is, feel free to do so. I'm going to go ahead and open up the Q&A. There should be a link in your Zoom to ask a question under Q&A. Go ahead and hit that, and we'll go from there. And so let me, Courtney can go ahead, and I guess I could kill the video here, and let me stop that and see what we have for questions. So let's see here. First one from Anonymous. Do you think a national mask mandate is a likely compromise between those who do not want anything versus those who want a shutdown? That's a very good question. I think if you followed my blog or social media posts or anything like that, I'm really right down the middle. We have a fund manager in our Cornerstone portfolios. I can't pronounce his last name, but we call him the double doctor. He has a PhD in biochemistry, as well as he's a medical doctor. Now he's managing money in the health and sciences type mandate. He's been the best source, but I've been on lots of other calls. Essentially, if you think about it, and finally, the CDC, by the way, just came out with the same advice that he's been telling us since March, is it's all about the viral load that we catch. The reason, masks aren't going to be 100% effective, but if you can reduce the amount of the virus that's getting into your system, then you're less likely to even have symptoms, or if you do, your body's able to fight it off. So I think I'm encouraged by the CDC guidance. I think a lot of people are kind of resigned to the fact, we've always wanted to be courteous of others to wear a mask. But to me, because I had the double doctor telling me from the beginning, it's about you preventing the viral load on yourself. Whenever we're out in public, we wear that. Whenever we're in a place where we can't socially distance, we will wear that. So I'm hoping that is, the solution. I know people will fight wearing a mask, but it really, truly, as the science says, it's about the viral load. We're just trying to bridge the gap to February or March, get the vaccine. The double doctor also talked about a herd immunity calculation by his estimate, and he fully says it's an estimate. Probably February or March is when we truly have hit herd immunity, which ironically is when we'll have a vaccine. So he's encouraged, I'm encouraged. I do think that's probably a way to go, because I truly think that the President-elect Joe Biden, I guess is what we should call him, he's smart enough. He's seen, remember, he was vice president during the economic crisis, and he had to figure out ways to not hurt the economy. I'm very confident we're not going to see a national shutdown. So good question. Next one, again, anonymous. Do you think Congress being split and more House seats going to Republicans than expected as a result of Biden's pick of Kamala Harris, who was among the furthest left of Democrats? 100% I do. I think, I didn't have it in this presentation, but one thing you saw is after the Democrats picked Kamala Harris, Joe Biden's poll numbers went down, and they continued going down until the debate on October 1st. So, and that's when Biden started to get his momentum back. And, I thought it was interesting, the fact that the Democrats picked a moderate in the primaries and then picked really one of the most far left people on there. Not my congressperson here, and even though we're 20 minutes from Richmond, but the way they've gerrymandered our districts, we're a rural county, so not our congressperson, but the one who was reelected to represent Richmond was actually, she's a Democrat, and there was a leaked conference call that they had done a couple days after the election, and she called out the Democratic leadership, and she said, we can't be pushing far to the left. We can't keep talking socialism. We can't keep talking defund the police, because we've already lost 10 seats and we're going to get killed in 2022 if we continue doing that. So I think it was a wake-up call, and I think it was a direct result of Democrats and Republicans alike being afraid of a really far left push from that. So really good question there. Question from John. What are your thoughts on the tax brackets we might see under Biden? Hate to do this, but I guess we'll know after they count the votes in Georgia after January 5th, because if they get control of the Senate, we know how they're going to look. Is we are going to see at least the very top rate, and I think, I'd have to look at the exact numbers, but 400,000 is going to go to 39.6. They're going to do things with individual itemized deductions. There's going to be a lot of things for that really the top two tax brackets, but it's really, we can't judge that now until we see what happens with the Senate, because if the Republicans get just the one, then it's going to be split. So I guess really for now, the status quo of what we have now is going to be what we're going to see, at least for the next 2 years, unless the Democrats win both seats in Georgia. Next question from Angela. What do you see happening to interest rates on home equity lines in the next few months? That's a really good question. Home equity versus just home. So home equity is a little bit more volatile. Mortgage rates tend to track the 10-year treasury. Obviously not the level, because 10-year treasuries are about 0.8, but they track the trend because banks are trying to get that spread. Home equity is a little bit more volatile. Really, it's what would cause home equity lines or mortgage rates to go up would be the thought that we're going to have inflation. And the two ways we could get inflation, one is the good side, is we have so much economic growth that everybody's afraid of inflation, and then rates will have to go up to fight that. So in that case, you should have a lot more money. You should be getting raises at work, finding better jobs. Your home prices would be going up in value. That's a good thing. The bad side of it, and this is where the deficit really starts to matter, is if we have inflation because people start devaluing the dollar, and I don't mean making it worthless, but just reducing the value, we would see inflation. And that's the problem that economists have been warning about for really the last 10 years is we've been spending money like crazy, even though the economy's been growing. And at some point, they're not going to be able to create enough dollars, and there's not going to be enough demand for treasury bonds. So then our interest rates will have to go up to meet that. That's a really, really bad situation. And that's one really for those retirees, and probably one that I think is going to cause your 10-year numbers from today, if you're invested in stocks, to be negative, is that sort of a shock where the market just basically says, hey, you guys cannot continue borrowing money at the rate you are and paying really low interest rates. So that would be inflation. So status quo, though, probably, again, don't hold me to this. I'm not a mortgage broker, but just looking at interest rates, unless we see really strong growth, they're probably going to hold strong. We've said it to people, going on for now 9 months. If a bank wants to lend you money on your house for 10, 15, or 30 years at 2 or 3%, please take them up on it. I don't know how banks make money on that. I don't know how servicing you make money on that. Obviously, if you're retired, mortgage debt can be the biggest factor as far as your ability to have a very comfortable retirement. So definitely don't be borrowing more money or cashing out. But if the bank wants to lend you money at 2 or 3%, don't try to fret and get another 0.5% lower. Just take them up on it. But again, financial planning wise, you want to try to not have mortgage debt when you're retired. So keep that in mind. Goodness, more questions. So let's see. Cody says, do you think the market will respond to Trump conceding if he ever does, thinking that it's finally over, or is the market pricing in Biden as the president-elect, regardless of the Trump legal battles? I truly think that, the market might have a little bit of opinion that, well, the president might try to really disrupt things. But almost from the day after the election, when they started seeing the numbers in the polls, the market started pricing, especially, here's the key. When they saw that there wasn't a big blue wave, they saw the Democrats lose seats in the House, they saw the Democrats not win enough seats in the Senate, the market just took off like crazy. And that was at a time where it hadn't been called for Biden yet. So maybe if they feel like we have a more of a president who will work with people through January to try to help and do the best for the common good of the country, the market might rally at that, especially if he starts talking about stimulus again. But the market's pretty much, again, from a couple days after the election, been pricing in Joe Biden as president, House going to the Democrats, and the Senate staying Republican. If that changes, that's when you start to see the market reaction. So good question. David, do you think a Biden admin will bring back various tax exemptions, specifically moving expenses? David, that's a great question. I remember when they used to tell us that we're going to reform taxes so we can do it on a postcard. The problem is with every exception, the tax code gets harder and harder. So it's really, I don't know that there's enough lobbyists to bring back just moving expenses into that, because for most people, when I've looked at their tax returns, they went from itemizing deductions in 2017 and earlier to fully, just taking the standard deduction because it went up by so much. For most people, unless you had a big mortgage and you donated a lot of money to charity, you didn't have enough to itemize. And now that's especially true. I've seen people with mortgages not able to itemize deductions anymore. So I don't see any real tax changes if, and this is a big if, the Republicans still have control of Congress. Again, if it swings Democrat, check your emails, check social media in early January, because we're definitely going to have to do a webinar, because that's a big game changer for everybody's financial plans if the Democrats do get control. And that's something that we all need to talk about if that's the case. So far it's not, so I don't see any questions. Last chance to get them in. I have one more, and I think I've talked to John before, and I sort of answered this already. When does the national debt matter, or will it ever matter? I truly think it will. The math doesn't work out. This is a global issue. We are going to see some sort of a reset. I don't know what that looks like. This election is kind of, if you think about it, it's just a holding pattern. You know, we saw enough people rise up to say, we want change. We're tired of it. You know, drain the swamp. We want to really fix things. So many moderates came out and supported Donald Trump, as well as, you know, on the Republican side. Because remember, Donald Trump was not the traditional conservative Republican. He knocked off a who's who list of people in the primaries because people were saying enough. He came in and he definitely magnified enough is enough. Well, if you look at the social cycle, the demographic cycle, and the geopolitical cycle, which are all colliding in the 2020s, it's all these pains, these things we've created over the last 40 or 50 years, these imbalances, you know, lobbying groups and tax write-offs and tax, you know, breaks and, you know, government spending plans, and all this is built up to a really divided country. And coming up in 2024 to 2028 or 2032, the math does not work out for Social Security. It doesn't work out for Medicare. It doesn't work out for state-run pensions. It doesn't work out for private pensions. There's just not enough money and not enough jobs in the US to make it a difference. So the national debt's going to matter. And I'm not opposed to debt if it's to invest in new things, if it's to invest in jobs. If, you know, going back to our son's Tyler's experiences, it cost us, we paid for it, $10,000 to get him a welding certificate. Everybody said, go, you know, get into welding. There was 25 slots open for 300 people applied for 25 slots at the shipyards. There's just not enough jobs, and it's prohibitively expensive. Not everybody can pay $10,000 to get a certificate for a trade. There's certain things that our government can do that will actually create growth. I mean, it's the same way. You're willing to borrow money to buy a house, yet, you know, that makes sense because the house should go up in value. So at some point, even you should be able to sell it for a profit. You shouldn't borrow money for a car because that car is going to depreciate and you're going to lose money on that deal. Now, there's obviously circumstances that change that. So it's the same way with government. If we go into debt for some sort of massive jobs program, training program, so kids like Tyler don't have, you know, to rely on their parents to pay the $10,000, and when they're done, there's actually jobs that will hire them without experience, because that's what Tyler ran into. We paid $10,000, and then every job the school sent him, every opening said you need experience. Well, how do you get experience if no employer is willing to make that leap? So there's lots of things that will need to happen, but our debt does matter, and it will matter. And I know, John, we've had that conversation. I know many of you probably wonder the same thing. When does it actually matter? It does. It does. Math hasn't changed in the history of markets. You could go back and study markets even in the 1600s. Too much debt leads to a crisis, leads to a huge correction in stocks, leads to a reset of our economy. And that's where we're going, somewhere in 2024 to 2032 election wise, but that means we're going to have volatility and pains going into that. So don't take the ability of the US to borrow money now without any consequences as what's going to happen going forward. Couple more. John, this goes, will Biden's admin pay off student loans? There are some things regulatory wise, even without Congress, that they could do. I'm pretty confident they're going to do that. There's people that need it. Let me just say again, everybody's situation is differently. If that can be positive for the economy, I'm not necessarily opposed to it, but I do think that there's going to be some repayment. They've backed down to saying maybe we'll pay off 10,000 of people's loans below a certain income. There's policies, but that can be done with an executive order. So that doesn't rely on Congress. Tim, okay. So he's asking about large companies that are getting out of the variable annuity business and what options are available to structure a plan where a client needs to create guaranteed income or a pension type income. And he says that's what his advisors are telling him. That's the real difficulty. If you're in a situation and you need some sort of fixed income, is we used to have annuity companies who, by the way, relied very heavily on the bond market and especially treasury bonds at higher interest rates to make these guarantees. Well, now that we've pushed interest rates down under 1%, even the best corporate bonds, you're only going to get maybe 1.5% right now. Junk bonds are yielding 4%. Makes it really hard to guarantee somebody a 5% income if you're an annuity company. Everybody's situation is different, and I know some people do need a guaranteed type product. What we try to do at SCM is, I had the chart showing our different models, is we're going to be opportunistic in the income market, where we can step in and try to take advantage. For instance, this is not a recommendation because we plan on getting out at the first sign of trouble, but we're in high yield bonds right now, getting that 4% or so yield, but we're also getting some price appreciation. That's one of our techniques to try to provide income to people. Getting a guaranteed product is very hard because high yields can go down in value very quickly and yields will go up, and that's when we get really excited to buy them. So if you're in a situation where you need some sort of a income stream, it is hard, and there are annuities out there that might provide them, but it's getting harder and harder because annuities are in the business to make money, and they can't promise you 3% if they're only getting 1 or 2% in their bond portfolios. So if you have an advisor, please reach out to them. If you are an advisor but not using us, talk to me. If you're just looking for a financial advisor, scmwealth.com, click the contact button. We'll put you in contact with somebody, an advisor who can help you. That's going to be key. Whether you have no money to invest right now or your whole life savings and you're worried about it, we're here for you. That's SCM's role. We were created for this. 2020 has proven we can't plan for everything, but if you have an ability to adapt, you can make it a little bit easier path. And I think it's proven again since 1992. We've had this setup where we can adjust to whatever happens without emotions. It's all quantitatively based on history, math, and the way the markets function. And if you're a client of ours, we truly appreciate it. If you're an advisor using us, we appreciate all the trust you guys have put in that. If you're just interested in hearing more and learning about the markets and doing it yourself, stay tuned to the blog, stay tuned to our social media. There's going to be lots of bumps in the road over the next 10 weeks, 10 years. It's going to be bumpy, and we're here to help, and we appreciate it, whether it's just you tuning in to get some advice on your own, or you putting all of your wealth in with SCM, or you as an advisor putting your trust in SCM to be your chief investment officer. So thank you for tuning in. I know we went way over. Appreciate all the questions. Hopefully we won't have to do one of these before the holidays. So happy Thanksgiving, Merry Christmas, Happy New Year. If we do, keep an eye on the blog and social media for future updates. Otherwise, for sure, we'll be doing one as we start the year. So stay healthy, listen to your doctors, and just spend time with family and focus on things that are important. Thank you.